Growing up, you've probably heard that the word debt is never a good thing. This could come in all forms: a warning from your parents, a passing thought in a movie you saw, or even a pamphlet that helps you get through it. People usually experience at least one debt in their whole life. I mean, why not? You get to borrow hundreds of thousands of dollars to buy a major thing, and you get to pay it off slowly. Whether you believe it or not, some actually benefit from debt. But of course, the system doesn't always work this way for everyone. Hardly ever. Just like there's a massive income gap in our world today, there is also a massive debt gap among all social classes. Yes, even rich people. There are those who are still paying off their student loans and those who are forced to live paycheck to paycheck just to get by. But here's the truth you've probably never guessed, and that is, not all debt is bad. In fact, some types of debt can even get you richer. Here, we take a look at the steps some billionaires have taken so that your debt serves you well rather than endanger your financial future. But before that, let's determine the difference between good and bad debt. This is important as it will give you a basis on where you are with your debt. Let's start with good debt. This basically means a type that allows you to accumulate assets that will increase in value. It's like the old saying, it takes money to make money. If the debt you take on helps you guarantee income and build your net worth, then that can be considered positive. Some of the examples are education, business, property, shares, and real estate. Bad debt, on the other hand, is the type that buys goods, services, or assets that have no potential to generate any income or depreciates in value. Some of these examples are cars, clothes, and consumables or credit card debt. So, let's get started. Number 1. Debt consolidation. Sustaining numerous debts is almost certainly charging you more in interest and fees than you need to be paying. It can often be beneficial to boost your mortgage and then use the extra funding off other inefficient bad debt such as credit card bills and personal loans. Your mortgage payments will remain the same, but you will use the lower interest rate to pay off higher interest debt. That is basically debt consolidation, which means combining more than one debt obligation into a new loan with a favorable term structure such as lower interest rate structure, tenure, etc. Here, the amount received from the new loan is used to pay off other debts. The rich use debt consolidation to pay off a low-interest loan in one lump sum by taking out a large loan. They end up saving interest as well as the finance cost of the small loan they owe. The borrower would now have to make a single payment to the lender rather than multiple payments to other creditors. However, it's important to note that debt consolidation can only happen on debts which are not tied up to an asset. This means debts like education loans, credit card debts, and personal loans. This is because these loans are oftentimes unsecured loans which can come under debt consolidation. Number 2. Margin investing. Investing on margin allows customers to place more stock than you have financial capacity for. First, let's talk about what a margin is. In finance, the margin is the collateral that an investor has to deposit with their broker or exchange to cover the credit risk the holder possesses for the broker or the exchange. Whenever an investor purchases an asset on margin, he or she borrows the remaining fund from a broker. Here's an example. If you had $50,000 in your traditional brokerage account, you would leverage your investment and open a margin account. A margin account basically means a brokerage account in which the consumer borrows money from the broker to buy stocks or other financial items. The securities and cash purchased in the account serve as collateral for the loan, which has a fixed interest rate. Because the consumer is invested with borrowed funds, he or she is utilizing leverage which magnifies the customer's earnings and losses. A margin account permits you to put a maximum of 50% of the stock's purchasing price. You must have $50,000 in cash and your broker would loan you an additional $50,000. Your $50,000 investment provides you with $100,000 in purchasing power. You can invest $100,000 in shares with this money. The rich can then pay back the loan and pocket the profit if the stock price rises. The disadvantage is that if your account's equity falls back on a specific level, your brokerage firm may issue a margin call. But that isn't really a problem for the rich since they're not worried about running out of funds. Number 3. Leverage ETFs. Leverage exchange traded funds or ETFs is a marketable security that uses financial derivatives and debt to amplify the returns of an underlying index. While a traditional exchange-traded fund typically tracks the securities in its underlying index on a 1-to-1 basis, a leveraged ETF may aim for a 2-to-1 or 3-to-1 ratio. ETFs which are leveraged allow investors and traders to increase their returns by going long or short on a specific index. Leverage ETFs such as those offered by ProShares allow investors to increase their gains and losses by 200 to 300%. ETFs are mutual funds that own a portfolio of securities from the index they track. ETFs that track the S&P 500 index, for example, will hold the S&P 500 stocks. Typically, if the S&P moves 1%, the ETF will also move by 1%. A leveraged ETF tracking the S&P 500 might employ financial products and debt to magnify each 1% gain in the S&P 500 to a 2% or 3% gain. The level of average employed in the ETF determines the size of the gain. This is leveraging, an investment strategy in which borrowed funds are used to purchase options and features in order to amplify the impact of price changes. You can invest in specific indexes, bonds, commodities, or sectors using these funds. The huge profit potential of leverage ETFs makes them appealing. With leverage ETFs, you can reach returns that other investors only dream about during market booms. The difficulty is that leverage ETFs can work against you in the same way they can work for you. Leverage ETFs can exacerbate losses by wiping out your entire investment in a few days unless you are an expert at trading in and out of these products. Number 4. Borrowing to create more wealth. It's time to start accumulating good debt after you've reduced your bad debt. This is known as gearing, and it can help you build wealth if you invest properly and your assets appreciate in value, since the income and capital growth from the investment pays off the debt and surpasses the cost of servicing it. Borrowing to invest, also known as gearing, can be a powerful way to increase wealth over time by allowing you to buy more investments that you might otherwise not be capable of. A decent idea here is to invest in real estate or stocks. Borrowing against your home's equity, taking out a margin loan, or investing in a managed share fund are all options for generating additional funds. After interest and other costs associated with debt have been factored in, gearing can offer a high overall return if your investments improve in value over time. The asset's capital growth and revenue can also be used to repay the debt, plus interest and fees. Number 5. Debt recycling. Debt recycling is considered one of the most effective strategies that the rich use in order to accumulate wealth over time. They do it by converting some of the debt that does not generate income into debt that may be efficient or that generates capital growth. Basically, it's a strategy that aims to help you pay off your non-deductible debt as quickly as possible, while also building up your wealth in a tax-effective way over the long term. It involves replacing or recycling the debt in your family with tax-deductible from investments. Debt recycling is best suited to a seasoned investor with a high tolerance for risk. If you don't have much experience with investing but are still interested in this technique, you can seek expert help from a financial advisor. Investing with debt can magnify possible losses and benefits. Furthermore, this method works best if you have at least a few years to wait for results. It's also crucial to have a source of income independent from your investments in case something goes wrong. For the right borrower under the right circumstances, debt recycling can be very beneficial. It saves on tax, exposes you to growth assets, and generates a passive income through your investments. Although debt is commonly thought of as a negative measure, if handled and managed effectively, it may be a positive one. Debt can be used as leverage to increase an investment's profits, but it also increases the risk of losses. To begin with, debt consolidation allows you to consolidate many debt obligations into a single loan with a more favorable term structure. Second, margin investing allows investors to borrow shares at a higher price than they have money in the hopes of stock appreciation. Third, leverage exchange-traded funds, ETFs, allow you to invest in a fund that tracks an index using leverage. Fourth, gearing allows you to build wealth over time even if you don't have enough money to start. Fifth, debt recycling allows you to convert some inefficient debt into usable ones that can generate income. Bottom line is, it may go against popular belief that debt has a negative impact on a person's finances. But when handled effectively and managed properly, debt can allow people to make purchases they wouldn't otherwise be able to afford, greatly increasing their returns.